The three major U.S. stock indices closed mixed in the latest trading session, with the Dow Jones Industrial Average edging down 0.07%, the S&P 500 rising 0.11%, and the Nasdaq Composite gaining 0.22%. This reflects a diverging market sentiment amid shifting short-term economic and corporate earnings expectations. Sector performance also varied notably. Within the S&P 500's 11 sectors, 6 declined while 5 advanced. The consumer staples and healthcare sectors led the declines, both falling 0.73%, while industrials and technology rose 0.51% and 0.43%, respectively. This underscores investors' differentiated outlooks across industries. Behind this divergence lies a mix of factors, including US-Europe trade tensions, tariff policies, and monetary policy expectations. Export-oriented companies are facing pressure from tariffs, with some seeing direct impacts on profitability and stock performance. The U.S. imposition of tariffs, particularly long-term protectionist measures on automobiles and industrial goods, has increased global supply chain costs and heightened uncertainty in emerging markets, weighing on cross-border investment confidence. For instance, South Korean media reported that the country's auto exports declined for the first time in 5 years due to U.S. tariffs. Some firms have responded by setting up local production facilities in the U.S. or adjusting their supply chains, highlighting how tariff policies trigger ripple effects across economies and capital markets. As a result, U.S. investors have grown cautious toward traditional consumer and staples sectors in the near term, while technology and industrial stocks have found support from policy incentives and innovation expectations, contributing to the uneven performance. Furthermore, currency dynamics and global capital flows are also influencing market movements. While a strong U.S. dollar typically benefits export earnings, its advantages are being offset by tariff pressures and industrial restructuring, leading to subdued corporate profitability and a more guarded market sentiment. Against this complex backdrop, investors should focus on the combined impact of global trade friction, tariff policies, and industrial realignment on corporate earnings and stock valuations rather than chasing short-term volatility. It is also worth noting that intensifying global tech competition and U.S. restrictions in high-tech sectors are having indirect yet meaningful effects on capital markets and industrial development. Subscribe for more insights and updates.